Hello, guys. Welcome. Hey, so, welcome to another webinar of our series. We're going to stick down the path of the technical analysis kind of route, if you like. Today, we're going to talk about RSI and Bollinger Bands, and more specifically, what kind of strategies you can come up with while using these two widely known kind of technical indicators, adding them to your setups, and in a sense, attempt to find some sort of valid entry points. And at the same time, once you do that, where you can spot some decent exit points in order to safeguard and maximize your profits from the get-go, and possibly minimize leaving money on the table. Okay, so today we're going to go over RSI and Bollinger Bands specifics, if you would like. We're going to do an intro. What kind of information do these two indicators convey? And nearing the end of the webinar, we're going to go in a live environment and attempt to put what we've just discussed in practice. Okay, so bear in mind that this is going to be super basic and simplistic. We have built upon a lovely framework so far. We've introduced various different topics that can come together and give you, in a sense, kind of a holistic point of view of how to approach the markets. Today, we're going to do just that. We're going to add two more parameters to our knowledge bank, if you like, RSI and Bollinger Bands, and we're going to do strategies with them. Okay, so without further ado, let's get started. This is a quick risk warning and a disclaimer. You can read that at your own time. We need to go over it right now. So, making a start, we're going to go with Bollinger Bands. Okay, so brief history, unquote, lesson or catch up. So this technique or this technical indicator in general was developed and created by John Bollinger back in the 1980s, if I'm not mistaken. So in essence, we're talking about two bands, hence the name Bollinger Bands, that are going to be placed around a median kind of value, okay, and an average value much more accurately. Okay, most of the time we're using a 20-day moving average, 20-period moving average, much more specifically. And in a sense, the upper band is two standard deviations away from this average line, this simple moving average of the 20 periods we just mentioned, whereas the lower band is two standard deviations. In a sense, you deduct two standard deviations away from the moving average. Okay, plus two standard deviations, you get the upper band. Minus two standard deviations, you get the lower band. And the reason why we use the bands from the beginning, or why are we using standard deviations? It's the term standard deviation, in a sense, the concept of standard deviation arises from statistics. Okay, so in a sense, what we're trying to do here is capture some sort of percentage of extreme volatile moves by using these two standard deviations, either above and below, actually, in order to capture what we call erratic kind of movements. And in a sense, while applying these two standard deviations, we are looking for the extreme scenarios, and you will understand what I mean by this as we progress through these few slides. Okay, so standard deviation is indeed a statistical concept that describes how prices are spread around an average value, and you can picture this much like in the fashion you've done in the statistics courses you've done either in university or at school. We're talking about a normal distribution bell curve kind of image that may pop up in your memory. So in a sense, you have the average value and you see how other values are spread around that, and that's why you get the normal distribution we call in statistics. So in a sense, two standard deviations ensure that you capture 95% of the sample size you have. Okay, so that's the concept, and that's what John Bollinger came up with in regards to this kind of tool, and has applied this to the trading kind of aspect of things. Okay, so Bollinger Bands, in a sense, measure volatility without a doubt, and this is for any given instrument you can come across with. You can apply this kind of technique, this kind of technical indicator. You can set it up at any given instrument you would like. Okay, so when the market becomes more volatile, okay, the bands, as expected, widen, because we're talking about the average value, the 20 period value, and then you have the 2 standard deviations. So the larger the volatility, or the larger the erratic movements, you reasonably expect to see the bands widen, because now these kind of erratic moves have been implemented in the value that the simple moving average calculates, in a sense. Okay, so I think that's easy to conceptualize. So when the market becomes more volatile, the bands indeed widen, while during periods of not trending or quiet periods, the bands indeed contract, so they narrow down. Okay, and they have different implications and different ways of interpreting them. Okay, and how you can use them when you apply them to your charts. Okay, so in a sense, the closer the prices move to the upper band, so remember the moving average plus 2 standard deviations, what we the basic interpretation of this is that the market is off both, or there is a bullish aspect to it. Okay, once you see prices being or trending above the moving average lines and moving closer to the upper band, that means the bulls can be, you can interpret that as the bull being in control, whereas the closer the prices move to the lower band, okay, so moving average minus 2 standard deviations, you can decipher this as being some sort of bearish conditions are actually taking place, and the market is going towards oversold conditions. Okay, so the upper and lower bands can also be used as price targets, and this is what we're going to use when it comes to Bollinger Bands strategies. Okay, so moving forward, this is a visual illustration when you apply the Bollinger Bands on a chart. This is how it will normally look like. Obviously, they're not going to be identical, because there is no identical price action between trends, between instruments. And when I'm saying identical, I mean exact. There is no exact mimicking of instruments between each other. They have some sort of element of correlation. Yes, I have not seen so far perfect correlation between two instruments. Perfect correlation meaning like assigning a value of 1 to them. You might have some 0.95 of correlation. That means they're super similar or identical, but they're not exactly the way they are. I think you understand what I'm trying to say here. Okay, so this is a visual illustration of how Bollinger Bands will look like if you apply them to your chart. Okay, so you can spot many, and you can come up with many different interpretations and narratives while looking at these charts. Okay, so when we say there is high volatility taking place and you see the band widening, we're talking about this period right here. And you can see indeed there is some erratic kind of movements taking place here. Whereas in quiet periods where you see low volatility, you tend to get the bands narrowing down, much like in this fashion. Okay, so you see the price action being confined within the 2 bounds of the Bollinger Bands. At the end of the day, what we care about are the excessive moves above or below the bounds of the Bollinger Bands. Those are the initial strong kind of signals that we be paying close attention to when we are dealing with, when we are putting in place and in practice the Bollinger Band strategy. Okay, same will be spotted here. So Bollinger Band is, in a sense, again, a technical analysis tool invented by Mr. John Bollinger back in the 1980s, having evolved from the concept of trading bands, simple trading bands, which can be used to judge or measure the highness or the lowness of price action depending on relative previous trades or trends. Okay, so the strong suit of Bollinger Bands, comparing that with the normal traditional trading bands, okay, is that the Bollinger Band, in a sense, evolves and adapts according to the volatility of the price action, whereas trading bands, in a sense, are you have a normal, as you have a simple moving average as a median or as a value, okay, and you place, for example, a 2 or 3% band on top and below, which are fixed, okay. Bollinger Bands are dynamic in nature and they adjust accordingly to how the market, how volatile the instrument is, whereas trading bands, the simple initial solution that they came up with back in the 1980s, does not have this kind of dynamic aspect to it. These are fixed bands depending on your risk or your tolerance as a user of this indicator. Okay, so there might be 3% or there might be 5% depending on that. They are fixed bounds. Bollinger Bands are dynamic and they adjust accordingly. This is the main difference you need to comprehend or understand what is taken away from this kind of slide. Okay, so Bollinger Bands consist of middle band being the end period of the moving average, and again the 20 period moving average can be adjusted accordingly. There might be 50, there might be 100, there might be 10 period moving average. That's up to your liking. 20 period is what the main academic literature came up with to be the most decent one. It's one way to describe this, but still. The upper band is K times an end period standard deviation above the middle band. So we're talking, when we say K in this kind of sentence, we're talking about the number of standard deviations. You can add one standard deviation, you can do two standard deviations, you can do three standard deviations. The higher the number of standard deviations, the more volatile price action the bands will cover. For example, as we just mentioned in the previous slide, two standard deviations capture 95% of volatile or the range of the sample size we have. Three standard deviations capture more like a 97%, if I'm not mistaken, or 99%. So one standard deviation will, if I'm not mistaken, once again, it covers like 90%. So depending on the amount or the incidences of extreme price volatility, you can adjust the standard deviation to the Bollinger Band to accordingly. Okay, that's essentially what it is. So typical values for a Bollinger Band kind of parameters are n being the sample size being 20 periods, and the k being the number of standard deviations, which is normally 2. You can do 3. Okay, so you can have a combination with an n of 50 and a k of 3. Okay, this is up to your liking. Okay, point is to understand what how these parameters, when altered, affect the way the Bollinger Band is going to be displayed on your chart and how much volatility is capturing or not. Okay, so the default choice, as we just said, is a simple moving average. You can do exponential moving average as well. Fair enough. But other types of averages can be employed. You can do weighted moving averages as well. Again, this is up to your liking. The point is, the concepts are this: you have a moving average and the standard deviations. These are two parameters, and you can adjust them. Okay. So interpretation: the use of Bollinger Bands varies amongst traders. So some traders buy when the price touches the lower Bollinger Band. Okay, and you will see it on a visual illustration soon. And they exit when the price touches the moving average in the center of the band, whereas other traders sell when the price breaks above the upper bound, okay, anticipating the correction. And this comes from the rationale, or at least the hypothesis, okay, this is an observation that prices or data tends to revert back towards the mean. Okay, volatile price action tends to be followed by a correction or a consolidation or a moving back towards a medium value, a median value, an average value. And that's why this concept of using the Bollinger Bands as a strategy came into fruition on this kind of principle, on this kind of observation. This is not written in stone, but this is an observation from people that have been dealing with price actions of instruments over a large amount of time. So you can extrapolate and come up to the same conclusion. If you look at a lot of charts, you tend to see a movement or a volatile movement towards, let's just say, upwards, okay, uptrend, and then you see some sort of a pause and the consolidation of a price action around a new median value or an average value, and then it continues to go extend and move volatilely and extend the current trend, whereas it's kind of rare where you can see price action of instruments continuously over long periods of time going the same direction without pausing or doing this in a zigzag fashion. This is kind of rare to see. Okay, so most instruments move in a zigzag manner. They go up and down. Okay, they have a clear direction or not depending on the situation. Okay, so what we're trying to do here is capitalize upon this inherent observation, okay, that prices tend to revert towards the mean. That's why we use the Bollinger Bands as a strategy. Okay, so when the bands lie together or close together, they move close together, this signifies a period of low volatility on any given instrument's price, whereas when the bands lie far apart or they widen, that means there is high volatility, okay, and you can expect to see some sort of choppy price action. Now, when the bands have only a slight slope and lie approximately parallel for an extended period of time, we call this a trading range or a consolidation phase, where you see price action oscillating or going up and down between these two bounds, which is, again, beneficial for the trader. You can capitalize upon this as well. Okay, so traders are often inclined to use Bollinger Bands with other indicators, and we have stressed this fact many times before throughout this series. Please do not use this technical indicator or any given technical indicator solely by itself. Find the ones that are complementary to each other, that gives you differing or different kind of information, but at the end of the day, they converge and can increase the percentage or the chances of being correct. Please use as many as you see fit. Don't overdo it, obviously, but at the flip side of the coin, please do not use one and come up with a trading strategy just by itself. This is, again, for illustration purposes only. The point here is we're going to use this Bollinger Band strategy in and of itself to understand how it works stand alone. And then once you understand how it works, add more stuff to your chart and see for convergence of information. Are they saying the same thing, or are they giving me divergent kind of signals? Use that accordingly. Okay, the point here is to amass as high as probability as we can before making an informed decision, in order to make sure that we again playing this game with the best terms available. Okay, so Bollinger Bands can be paired or coupled with a non-oscillator kind of indicator, much like chart patterns and trend lines, or any given other indicator, and which, again, the point here is to confirm the recommendation of the Bollinger Band and not take it for granted by in and of itself and go forth. Okay, let me see what is the next slide. Before going into relative strength index, let's look at Bollinger Bands in action. Let me get my chart up and running. So what do we have here? We have Alphabet, talking about Google, and this is a chart we've done over the past, was it, a few weeks ago. Okay, that's kind of fits the narrative quite nicely. You can clearly see, okay, the projected kind of trajectory of Apple's price action. You came up with a conclusion that this might have been treated as a dip buy, if I'm not mistaken, taken for granted what we can see in front of my head right here. May have served as a dip buy opportunity, and then you see price action running top to this kind of level once again. Unfortunately, this kind of trade would have been closed kind of prematurely, as you can clearly see here, would have been stopped out, even though at the end of the day kind of held above this lovely support level, albeit this kind of volatile kind of rip towards the downside. At the end of the day, decent trade, 10%, risking 2.6% to get 10, risk reward ratio of 3.85. Decent. Unfortunately, stopped out. Okay. If, for example, we have at that point in time, we would have just said, you know what, we're going to wait for the signal of reversal first and then enter. This would have been the appropriate way to enter. Okay. At that point in time, we quote unquote rushed ahead of us. Okay. Nevertheless, let's use the Bollinger Bands. We leave this behind. We move all drawings. Let's add the Bollinger Bands to the chart as well. In 1 sec. Let's move Bollinger Bands. Let me move something. Okay, let's remove the moving averages. Let's do Bollinger Bands. Okay, so this is in a sense how Bollinger Bands will be seen once you apply that to your charts. Okay, let's take a look at the settings before we start. So we have a 20 period small moving average, simple moving average, excuse me, and 2 standard deviations, and we're going to play a little bit with this to see how that alters the picture. Okay, so let's go ahead with the basic kind of settings, parameters, and see how you can use the Bollinger Band as a strategy, just in and of itself, without using anything else. Okay, so we're looking for periods of extreme volatility where price action has exceeded either above or below the upper or the lower bound of the Bollinger Bands in order to get our first signal. Okay, so we use excessive moves for us to place the trade. So one I can clearly see right now is one right here where you can see the price action exceeding the upper bound of the Bollinger Band, says the market has went way ahead of itself. Okay, or at least the bullish sentiment is super strong. We're talking about overbought conditions. Therefore, we expect the price action from here onwards to crawl back into the normal trading range. So one strategy might be, okay, there is plenty of ways of using this tool in order to come up with a strategy. One might be that whenever we see the price action breaking above the upper bound of the Bollinger Band, and then we could see thus we extrapolate that the price action is going to swiftly come back down towards the medium value, which is the yellow line, moving average. We would have gone and do this short position up there. Okay, what is it? Short position. As soon as the price action re-enters the range of the Bollinger Bands, okay, you enter a short position, we risk the highest level it has reached. So we're talking about 2.85%, so no, around 3%, and the target would have been the midline, okay, the average, moving average, the yellow line, okay. So this is one way to place this, and we would have, in a sense, earned around 8%, risking 3%. So it's a risk reward of around and about 3. So it's a decent trade. Obviously, you don't price action does not always come back towards the mean. At this point in time, it did. So this is one way of playing this. The other way of executing this kind of signal and setting up with a strategy with Bollinger Bands would have been see the break above, expect the price action, and see the price action breaking once again under the upper bound of the Bollinger Band. Okay, so the entry would have been exactly the same, risking the same, using the same level as a stop loss. Okay, using the same level as a stop loss. The what is it? 153.5, whatever that is, and the exit. Okay, the take profit. Another way of playing this would have been down here. Okay, to the lower end of the Bollinger Band, expecting that, you know, it has breached the upside. Expected now we have exit strategy to the level where the price action is going to move closer to the low band of the Bollinger Band. In this kind of case, we wouldn't have gotten an execution. Position would have been open. The maximum amount of money we could have made is something like 12.3%, if and only if we were watching this closely and manually exited the position. Okay, so the safe way of playing this, or the traditional way of playing, is wait for the break above or below of the upper band or the lower band of the Bollinger Band, enter the position either long or short depending on the situation, have a target, the midline, the average line, okay, the 20 period moving average, and this would have been a modest win. Okay, in this kind of case, we're talking about a near 3% kind of, excuse me, 3 risk reward ratio, 3-1. Very nice. Let's go ahead and find another incident of either we saw a break above or below the Bollinger Bands. So we're going to use this as an example. Okay. Once again, you see the break of the price action below, in this case, the lower bound of the Bollinger Band. We are waiting for the price action to cross back within the bounds once again. Enter a position, let's just say somewhere about there. We risk the lowest it has reached. So in this kind of case, is 6%, which is a lot. Compared to that, obviously, what we could have and won, or expected to have won, which is we expected the price action to rise and rally back towards the midline. In this case, the first wave did not give us an execution. It approached this kind of level, the 102.5, but we wouldn't have gotten an execution there if you have stayed long enough in the trade. Okay, you see here that we didn't get a stop out as well. The price did not reach that kind of level. In the second wave, okay, we actually get an execution, but it would have been somewhere in this kind of area. Okay, and again, remember that this line moves along with price action since it's a moving average. So the profit target at this point in time would have been up there. If you got an execution there, the moving average line would have been up there. Okay, let me use this for visual illustration. Okay, so the take profit order would have been set somewhere up there. So the most accurate one would have been here. So you can adjust accordingly with the moving average line. So in this kind of case, we luckily got an execution up here. Okay, after what is it? November with January, so we're talking a month and a half. Obviously, you can narrow this down to much shorter time frames. The same principles apply, but the longer the time frame you use, the less erratic the movements will be. Therefore, you're going to have much more quote unquote reliable indications by the Bollinger Band. If we use a 1 minute chart, you're going to see the breach of the Bollinger Band way too many times, and sometimes you have a lot of false signals. Something else to keep in mind when you apply this kind of practice to smaller time frames. Okay, but the strategy is exactly the same. Either you play this, enter the position, the entry, the signal is exactly the same for entering. The exit is the adjusted. Okay, and you can use the midway. Okay, the level of the moving average as a target for your exit, or you are waiting for the price action to once again rally back towards the opposite end of the Bollinger Band, because we've got a breach below, we expect to see a breach above. Okay, doesn't work most of the times. Safest way, once again, is to use the midline, okay, as a target for exit. Okay, in this kind of case, risk reward ratio would have been 2 point, if we've been realistic, 2.7. Okay, if you for some reason you go cold feet, you would have exited the position with the best at best with 2.2, which is in this case 14%. You risk 6% to get 40. It's decent. Okay, another example is this area right here, even though we got a momentary break above it, it's temporary, excuse me. Same scenario applied, break above, you expect the price action to fall back within bounds. To get back within bounds, you play the short order in this kind of case because we have the breach of the upper end of the Bollinger Band. Risk, in a sense, to lose 5%, 4.5%, whatever that is, with prospect of getting 8. Okay, so risk reward ratio in this kind of case is not great at 0.72, but you can clearly see the price action moving once again back after the volatile move back towards the same case here, excess, and then you move back towards the mean. Same here, break above, excess, and then moving back towards the mean. Okay, you can see the price action fluctuating, okay, somewhere near the mid bound level. Okay, in this kind of case, if we have used many other different indicators, for example, RSI or MACD or R Williams or trend lines or anything, moving averages, just using 2 simple moving averages with different kind of time frames, you have got a lovely signal to enter the position somewhere in here. Okay, because you see the strength of the bulls is growing. This kind of case is kind of narrowed down, but this kind of movement would have been spotted while using, for example, a moving average or a MACD indicator, which will indicate the, in a sense, the shift in momentum and strength of the trend. Okay, you can clearly see down from here, crossover between the moving average, the MACD line with the signal line. The first indication was down here. The valid place to enter the position would have been when the blue line, the MACD line, crossed above the threshold, the 0 line, which is this right here. Okay, which is this. Okay, this is the midline. A break above gives you the definitive signal to enter, which would have been somewhere in this region. Okay, and we're talking about swinging this player, enter a long position there. In a way, whenever you see the upper Bollinger Band being breached, set that as an exit target using the latest level as a support. Okay, in this kind of case, 3.84 when it comes to the risk reward, much nicer compared to using Bollinger Bands. Okay, so these are stuff you need to take into consideration as well. Don't use Bollinger Bands in and of itself. Please use other stuff. Also, let's remove all these things and get back to the slide, and we're going to do RSI. Okay, so relative strength index is an oscillator. Another technical indicator you can add to your chart. It's not going to be on top of price action, much like the Bollinger Band. It's going to be below on the separate panel, below the price action. Okay, and again, RSI is an oscillator. It's something to remember. Let's go over the specifics. So RSI stands for Relative Strength Index, and it measures the speed and change of price movements. And we're talking about usually compiles information of 14 periods. Again, the 14 periods can be adjusted accordingly. You can do 21, you can do 5, you can do 10, you can do 15, whatever that is. In a sense, what you need to understand is that RSI measures the speed and change of price movements, of price action. So why we care about this? If we continue to see, for example, RSI being above the 50 level, okay, which is the threshold between who is in control, the buyers or the sellers, the bulls or the bears. If you continue to see the price action, if you continue to see the RSI being above the 50, gives you sense that the bulls are in control, and the steeper the readings or the line turns out to be, that means the stronger or the more volatile the momentum and the speed of change of prices is for that specific instrument. That means the trend is going to accelerate at a much faster pace, which is something you need to take you need to pay attention towards too, okay, when you want to time your entry, and when you see the RSI kind of loosening up or losing momentum by being, I don't know, flattening out, you use that as your exit. That means that the bull's strength is waning out, it's losing momentum, and you know what, maybe the bears are going to enter the picture and drag the price action to lower ground. Therefore, use that waning of the strength as your time to exit. Okay, and you will see this when we're going to study RSI strength. Okay, again, these are both Bollinger Bands and RSI are complementary to your technical analysis, where you're going to do charting analysis in a sense, where you're going to do study the price action, study price patterns, okay, chart patterns, draw your trend lines, find your support, key support and resistance levels. After that, then you add the Bollinger Bands and the RSI to see confirmations. Okay, please do not use either Bollinger Bands or RSI in and of themselves, by themselves, and go at trading. Okay, please use many other stuff to get confirmations, again, in order to increase your chances of becoming profitable. Okay, that's a plain reason. So the RSI, in a sense, again, it's an oscillator. It measures the speed and change of price action, and it ranges between 0 and 100. You will see this plotted on a chart, and alerts traders for overbought and oversold conditions, much like the stochastic indicator or oscillator does. Okay, we're going to see stochastic as well. So 0 and 100 are the extreme values. Okay, 50 is the midpoint. So prices above values of RSI above 50, that means there is bullish momentum surrounding the price action of that instrument. When there is values of RSI below the 50, that means there is bearish momentum surrounding that instrument. Okay, so most of the times traders use readings above 70. Okay, so you have 0, 100, the extremes, 70 and 30 are what we call overbought and oversold conditions, and that's why, and you will see how we use these kind of areas as checkpoints. Okay, when it comes to judging where the price action is going to move towards. Okay, so the relative strength index is a technical indicator used by technical analysis professionals in the technical analysts in financial markets. And now it is intended to chart the current historical strength or weakness of an instrument based on its closed or closing prices in a recent trading period. Okay, so it uses this kind of aspect as well. So based on the closing prices of the recent trading period, gives you straight and out the confirmation that we're talking about a lagging indicator. RSI does not provide information about what's going to happen in the future. It compiles information about what has already happened. Okay, it compiles information about the past. It does not give you any indication of where the price action is going to move towards to next. You can extrapolate that by looking at price action and the RSI. But again, we're talking about probabilities. This is not what you call a glass ball where you can predict the future. No, it's a lagging indicator compiling information about the past. Okay, it acts as mere confirmation of where the price action has came from. Okay, so the RSI is classified as a momentum oscillator, again, because it measures the speed and change of price action, and it measures the velocity, how fast the price action is actually evolving, and the magnitude of the directional price movements. So the steeper the slope of the RSI values, or the RSI line, which is a compilation of RSI values, the more confirmation you have that the price action is going to accelerate at a much faster pace compared to what it has done in the near past. Okay, so momentum is the rate of rise and fall in price action. Okay, a super important concept, a super important aspect of movements of price action within the financial markets. Okay, so the RSI computes momentum using the ratio of higher closes and lower closes. Remember, based on the closing prices of the recent trading period. Therefore, if it compiles, it comes up with a ratio of higher closes and higher closes and lower closes. If you had volatile price action that led to higher closes, that is gonna distort the actual numbers of RSI. Okay, something else, another dimension you need to include in your assessment when you look at RSI. Okay, so keep this in the back of your minds as well. So instruments that have more or stronger positive changes, so move upwards 5%, move upwards 7%, move upwards 9%, etc., etc., etc. Higher closes over time tend to lead to higher RSI values. Therefore, on the flip side, lower closes over time tend to lead to stronger negative changes in the RSI. Okay, again, it's a ratio of on closing prices of past price action, lagging indicator. Please digest this. Okay, so the RSI is most typically used on a 14 period time frame, measuring the scale from 0 to 100 with high and low levels marked at 70 and 30. You can do 80 and 20, wider bands for wider levels for establishing where the oversold or overbought conditions are, or you can do 90 and 10. Okay, but they're used much less frequently. Again, at the end of the day, if you get a reading of 90, you get a sense that it's a super strong bullish momentum. Therefore, on the flip side, value of 10, a rare occasion, both 90 and 10. That on the flip side tells you that it's a strong selling momentum. Super extreme oversold condition. You can use that accordingly. Okay, the market is supremely oversold. You can use that as a possible deep buy opportunity, expecting that the price action is once again going to move back towards the mean. Whereas when you have supremely strong over bought conditions, that means an RSI above the 70, possibly 80, and getting a 90. You're going to use that as your reference point to enter a short position, extrapolating that the price action has went way ahead of itself and now it needs to correct, okay, and move back towards the mean, consolidate, and then possibly move to high ground. Okay, so you use that accordingly. It's the same philosophy with Bollinger Bands. You need to set the extreme values to get the confirmation that a possible reversal may occur, or you use the 50 level as your entry point and you have the 70 or the 80 RSI as your entry. You're going to see what I mean shortly. Okay, so this is a visual illustration of the past instrument. What we have here, 1 second, guys. We have dollar yen. This is the RSI below the chart. Unlike the Bollinger Bands, the blue line up here and here, these are the Bollinger Bands, and you see a golden and a blue line, dark blue line, this and this, which are the moving average. For the time being, let's focus on the RSI. You see this level being the 70. We branded this threshold, we just branded as overbought conditions, and the 30 are the oversold. 50 is the midline, is the threshold between who is in control of judging who is in control, buyers or sellers. Okay, in this kind of case, we see not that much of an erratic movement from this period until here. Okay, you see the price action floating aimlessly between 50 and above 50 and slightly below 50. So yes, moderate kind of bullish sentiment here and moderate selling or bearish sentiment here. Momentum much more accurately after from this period onwards, and you can, by the way, you can also see this from price action. Look at this mere nonsensical kind of movement, kind of matches direction of the RSI close to the 50. That gives you, by the way, if you have values of 50 for RSI, the basic deconstruction or deciphering of these values around the 50, around about the 50, you can brand this kind of movement as momentum is not there either towards either direction. So we're talking about, we brand this kind of movement as a period of indecision from the most or the best. Nobody's taking the initiative. Nobody is pushing the price action towards either direction. Okay, so aimless swiveling or zigzagging between the close range. What we care about at the end of the day is the extreme values. You can see extreme value here, extreme value here, extreme value here, and there as well. Okay, and also you can spot the absence of any given value from the seller. So absence of selling, at least super strong selling sentiment or momentum by the bears. What would you reasonably expect? Price action to continue move to higher ground. Okay, so you don't see these kind of cyclical kind of movements between buyers and the sellers. You can see dominance of the buyers. You can get this confirmation by looking at the RSI, which did not cross below the 50 for an extended period of time. You can clearly see that RSI values did not cross the 50, the threshold level, for a severely long period of time, which led to, in a sense, because due to the price action decrease, was super bullish sentiment driving the dollar yen pair to high ground, mainly because of severe strength of the dollar and absence of strength by the yen. The flip side, severe weakness of the yen and severe strength of the dollar push this pair to higher ground time and time again. Okay, higher highs, high lows. Okay, higher highs, high lows, high highs, high lows, and it goes on forever. Not forever, but at least for this kind of standard period. So what we care about is, since we got this kind of cyclical kind of movement, indifferent kind of movement between 50, slightly above 50 and slightly below 50, what we're going to have cared about is this area here where you see these overbought conditions. This is where we start paying attention. We see the retracement of the RSI, but the consolidation of the line above the 50 level gives us an indication that is strong bullish momentum, a strong bullish sentiment surrounding the dollar yen pair. What we would have judged as a lovely entry point for this would have been this area right here. Once you see the consolidation of RSI values above the 50 and then surge into high ground with this kind of magnitude, also pay attention to the slope of the RSI line, kind of steeply took off. This is an area that interests us for entering a long position. Okay, so buy signal would have been somewhere in here, and then from here onwards, we are waiting to see extreme selling conditions, extremely overbought conditions in order to time our exit, which is up until this point here. But the exit, from our point of view, would have been as soon as the price action, or excuse me, as soon as the RSI indicator cleared back below the RSI level of 70. So in this kind of case, our ideal exit will be somewhere in this region. Okay, this is what we would have got. Okay. We're going to see this on a live environment. If you're not, please bear with me. Let's see the next slide. So let's do the RSI first, and I think I have it down here alongside the deleted the wrong thing. So we need to get rid of the MACD, and this is the RSI. It's going to be plotted below your chart. Let me make the line much more visible. Okay, I think this will suffice. So, doing the same exact thing as we have done with Bollinger Bands, let's do the same scenario. Let's see if we can spot overbought and oversold conditions. Key area is clearly see this being marked as an area where we would have placed extreme attention to. And if we did not manage to capitalize on this kind of uptrend, even though it's clearly seen here that the RSI moved closer to the 30 line, but it did not break below it. The fact that we see this kind of formation of a new low, okay, using the tool, excuse me, this formation is super important. Now, actually, let's do a smaller time frame because there is not much information. Let's do a small time frame to see that you're going to get much more frequent values are there above or below the 70 and 30. See what I mean? Do hourly chart. It's adjusted accordingly. Same goes for RSI, by the way. You can clearly see here. You can clearly see here. You can clearly see once again down here slightly. But yeah, let's do the RSI analysis on an hourly basis. Let's continue to get more disconnection. Okay. Area number 1 is down here. You can see the RSI value being what? 20. So this is an extreme kind of overextension level. How can we use this to time our entry? Is that using the same principle? Price action or volatile price action that exceeds quote unquote the norm and reaches oversold or overbought conditions can be treated as an entry point for us to, in this kind of case, it's going to be a long order, expecting that the price action is going to revert back towards the mean, much like the same fashion we have done with Bollinger Bands. We're going to use the same kind of scenario. When did this occur? Let's just say somewhere in this kind of period, oversold conditions. Yep. So we use this as an entry point somewhere in there. Now you have to be cautious, okay, in regards to where you're going to set your stop loss order. Okay, let's assume that we have placed it down here due to the fact that we have a support level here. Okay, obviously for the sake of the example, we're going to give it some more time and more room to see how you can use it accordingly. And in a sense, enter when you get oversold conditions. So you go long when you have oversold conditions, and then exit near the midline, or the target is going to be when you reach overbought conditions. Okay, which is either here or in here. Okay, so let's see whether that would have been a viable way to enter trade. Okay, so the first time we see the RSI rally from this kind of low level, the oversold back towards the 50 threshold would have been somewhere in here, and corresponding to the chart would have been in this kind of area. Okay, somewhere in there. So you can clearly see straight away after this fake out down here that the most we would have gotten using the 50, the threshold, as an exit would have been what, almost 2.5%, and we would have risked, if and only if we have left this far, let's just say stop loss, the target of the stop loss to be that low, would have risked getting what, 4%, losing 4% in order to get 3. Definitely not sustainable, no reason to enter this trade. Okay, but if we would have used the next time that we see the RSI breaking above the 70 level, which is somewhere in here, the next target for us in regards to setting the take profit would have been somewhere in there. Okay, so risking in a sense what, 4% to get 5.5, still not an ideal entry and exit for us. Okay, and bear in mind the whole thing happened in a blink of an eye, so we've got a gap down on the 31st of January 2024. At that point in time, you can see that the RSI indicator recorded an excessive value of 20 oversold condition yields. So if we would have jumped straight into the market while using solely the RSI of 20 as a valid entry point, we would have burned out super quickly, because if, let's assume that the whole thing, this from this line onwards, did not happen, and we see the price action being somewhere in here, and we enter a long position there, from my honest point of view, my stop loss would have been somewhere in here, max somewhere in here. Okay, so I'm going to say this and this area are critical. Also, this is the lowest I'm allowing myself to see the price action going, and this is what the lowest amount of money, the most appropriate from my point of view, as a valid exit point in terms of unfavorable conditions would have been. So I would have, in order for the risk reward ratio to come up decent enough to make me enter this position, okay, would have been 1% risk, getting 1% with, risk losing 1% with a prospect of winning 2.5. Okay, this is decent for me to enter, even though I would have lost the position quite here. Okay, would have been stopped out. I would have lost 1%, risking 1% to get 3, stop out order. So you see, when you go into much smaller time frames, the RSI indications are getting much more distorted compared to when you look at this trade from a longer standpoint of time of view and allowing yourself, giving yourself the privilege of time and the correct involvement of price action. Okay, again, also something to note is that extreme sharp drops of price action distort, okay, RSI values, which gives you false signals, much like the one we just saw right here. This would have burned me out, would have lost 1%. If you practice correct risk management, you will lose small amount of money, okay, with the prospect of getting a lot rather than just blindly opening a position without stop loss or take profit and then just leaving it to chance, okay? In this kind of case, I would have been more willing to lose 1% and be wrong rather than just keep a position open and risk, for example, losing 4% in order to get 2. Okay, this is not a viable trade for me. I would have stayed on the sidelines and waiting for further confirmation, and that's why we use other confirmations as well to this. Okay, so another way of playing this would have been a wait for the RSI indicator to close above the 70 level in order for us to place a short order, so which is somewhere up there. You wait for the price action, I wait for the RSI indicator to come back down from the 70, below the 70 level to enter the short position. Would have been somewhere in here, marking here, exactly at this kind of area. Right here would have been my entry point for a short order. You see also that it confirms the Bollinger Band as well. I would have risked maybe this back to this kind of level, so 1.6% in order, and my take profit would have been at an area or at the level where you see the price action, excuse me, RSI closing in near the 30. Either here or here where you can see the clear break below the 30 and then rebound above it. So let's just use the same first scenario. Exit would have been here. Okay, so would have been a 1.92, so 2 to 1 risk reward ratio. Not ideal, it's decent, fair enough. So you risk losing 1.6 to get 3%, fair enough. Or I'll wait for the clear break below the lower bound of the RSI, which is 30, okay, which is at this point in time there, and exit the position down there with near 5% gain while risk losing 1.6. Okay, much better risk reward ratio, 3 to 1. This is, in my books, an ideal kind of trade, at least from a short-term point of view. Okay, and again, this is how you can use the RSI in practice. Okay, there are many other stuff you need to know and pay attention in regards to RSI. You can treat RSI as price action as well. For example, looking whether it confirms the lows on the chart. So you see here over extension, okay, over sold conditions here and here. Price action, however, tells a different story. You see a low being formed there, okay, and the next low is lower, even though the RSI is at the same time. This gives me, this in a sense spits out what we call a divergence. If under normal conditions, this low, okay, right here, this low right here from the RSI, under normal circumstances should have reflected this kind of magnitude as well. So you would have expected to see RSI being down here rather than up there. Okay, so the fact that the RSI has not mimicked price action and it has, in a sense, bottomed out, or at least formed a double bottom near the same level, gives me indications that the bulls may be sitting on the sideline and being ready to push the price action to higher ground, I treat this as a valid entry signal, okay, at the time where you see the RSI breaking definitively above the 30 level and coming back up, okay, moving upwards, creating in a sense. You see this kind of lovely line, okay? So higher lows, not only on the price action, but also on the RSI, is giving you also lovely indications, okay? You can see leveling out at the same level, whereas price action is forming a new lower low. I pay close attention to this area right here, and in order to time my entry, in this case it's a long order, let's just assume that you enter the position somewhere in here, okay? You risk the bottom being here for a stop loss. You can align that with another bottom much more accurately, would have been somewhere in here, okay? So you get another confirmation there. This is the area where I will tolerate for the price action to move close to, but not below, which I'm risking in a sense 1.66, and I'll wait for the RSI to head back up towards the 70 over bottom level, okay? In this kind of scenario, the earliest time we get a clear break above it is here. The ideal exit point would have been there, okay? Somewhere in there, okay? So in a sense, this was a 7.7% gain while risk losing 1.6%, risk reward ratio of 4.66, superb, okay? Very, very nice, okay? Even if you hold it this for much, much longer, the ideal is this, because you can clearly see as well the RSI breaking below the ascending trend line I just drawn, okay? Much like the same fashion you use on a price action, okay? Much like this, okay? Ideal would have been somewhere in there. And you see the price action breaking below the ascending trend line, okay? This is how you can treat the RSI. Again, please do not use RSI solely. Use other stuff as well, such as the trend line we just drawn here, much like the same analysis we do with price action down here using the RSI. You can use also Bollinger bands at the same time. You can do MACD. You have many different things. Okay, please use all of them together to increase the chances of becoming profitable. Okay, so back to the slide. Let's do a review of the principles of RSI, and then we're going to finish off. We're way past our time. So finishing up, let's overview principles. So when price moves up very rapidly, at some point it's considered to be overbought, and this is what we just saw where you see RSI values being above 70. Likewise, when the price falls very rapidly, at some point is considered to be oversold conditions. We're talking about the 30 level here. So this gives the rise for a potential reversal scenario, and this is what we do. We play their reversals using the RSI. This is one way of going at it. This is the most widely known case of using RSI anyway, is to play the reversals, not confirm and go with the trend. Okay, so the level of the RSI is a measure of the stock's recent trading strength. Okay, and remember, it's a lagging indicator, not a forward-looking, not a leading indicator. Also, the slope of the RSI is directly proportional to the velocity of the changing trend. So the steeper the slope, the higher and the faster the price action is going to move towards to. Okay. The distance traveled by the RSI is also something you need to pay attention to, which should be proportional to the magnitude of the move. Okay, so the faster the price action, the faster the RSI moves from one value to the high ground, the slope of the RSI and how quickly got there, and as well the distance it covered are also components that you need to pay attention to. So it is believed that tops and bottoms are indicated when the RSI goes above 70 and below 30, and traditionally RSI readings greater than the 70 are considered to be overbought, whereas readings below 30 are what we call price action has reached oversold territory. Okay, so between 70 and 30, what we call normal conditions, and if you see values of RSI around the 50 level, we call this an period of indecision. Okay, non-trending. Okay, so I think a few more slides to finish. Actually, one slide to finish. So overbought and oversold conditions. Analysts considered that failure swings above 70 and below 30 on the RSI are strong indicators of market reversals, and these are the ones we just saw on a live environment. So assume that the RSI hits 76 and pulls back to 72, then rises back once again above the 77. If it falls below the 72, analysts will consider this a failure swing above 70, and in a sense you will not see the reversal of the price action. Okay, so that's the name failure swing comes from. Okay, it does not reverse the trend much like you expect while you're using the RSI. Okay, so final chart formations are areas of support and resistance, can be sometimes more easily seen in the RSI chart, and this is what we've done. Price action, where we draw the trend line below, if you remember, and you see the double bottom where you see the divergence between the price action and the RSI. And now again, something else you look at. And if the relative strength index is below the 50 level, generally means that the trading instrument instrument's losses are greater than its gains, and the opposite is also true. And that's how you judge whether there is bullish sentiment or bearish sentiment surrounding angles. Anyway, this, in a sense, slide brings us to the end of today's session, guys. If you have any sort of questions, please send them through before we finish. Again, next week, I'm not entirely sure what we will be going over. Possibly it's going to be technical analysis, and we're going to delve into much that fashion down that road. Once again, I don't see any sort of questions for the time being. That means we have reached the end of today's webinar, guys. Thanks for watching, and we'll catch you next week to hopefully get another brief, short lesson for down the technical analysis route. And again, carry on with our webinar series with introducing these kind of concepts and applying them on a live environment to see how they can be used for you to enter next positions accordingly. Okay, so have a lovely weekend. Take care. Bye bye. See you next week. Ciao, ciao.